Let's get in Andrew Swan, Head of Asian Fundamental Equities of BlackRock, who joins us on the show from Hong Kong. Andrew, good having you. Thanks much for taking the time out. Your view on India's valuations versus other emerging markets, does it look favorably placed?
India trades at a premium to the rest of Asia on about 14 times PE, 12-month forward, versus Asia at about 11 times. It historically has traded at a premium to the region, so that doesn't overly concern us. What we're really looking for in India is the government moving ahead on the reform process, which will hopefully get economic growth back on the right path. And if you look forward over the next 2 to 3 years, India's growth could be re-accelerating, which would certainly justify the premium valuations in the region.
Right. So talking about policy momentum, can it help overcome fiscal challenges for India?
Some of the policy reform will definitely help the fiscal situation in India. The one that we are really focused on is the potential implementation of a GST that will, if effective, and probably not really be introduced until 2014, if introduced, that will certainly solve some of the revenue problems the government has had. And other measures to perhaps solve some of the expenditure problems, such as subsidy reduction, we're also quite hopeful.
Right, so does RBI have room to maneuver then?
We have started to see inflation come off a bit. What I think the RBI would like to see is this implementation of reform and therefore some growth coming back into the economy, or at least signs that some of the supply side is being addressed by reducing the infrastructure bottlenecks. I think there is therefore scope that the RBI could reduce interest rates going into early 2013.
What are your views on Indian sectors, financials, IT, healthcare? Which one do you like the best and which one the least? And more importantly, why?
I think the most interesting part of India is probably, if they do get this reform process back, India is underinvested. And therefore, we are looking at opportunities within the investment sectors of India, directly through infrastructure companies, but indirectly through the banking sector, which has been burdened with potential for bad debts from lending to that sector over the past couple of years. So I would say financials are probably our preferred play at this point in time, but we are looking at infrastructure, given the government's reform process going forward.
Andrew, so what's the general global risk environment looking right now as well as for the next few weeks?
Short term, very difficult to predict. Clearly, we are heading into a bit more uncertainty around the US, and it's always very hard to predict the short term. But as I said earlier, I think 2013 is looking more optimistic, which is really what we are focused on.
Solution for the fiscal cliff by the month of January. So what happens in the interim period to equity markets?
We do expect a resolution, although there is clearly risk associated with that assumption. We are dealing with policy and politics, and they tend to be very uncertain and hard to predict. So there could be some volatility around the end of the year, particularly if there is a delay in the resolution of the fiscal situation in the US.
Right. Andrew, the recent data coming from China is encouraging. Do you think that China can have better growth rate in 2013? And if yes, won't that be favorable for equity markets?
We are more optimistic about China's growth and therefore equity, given where valuations are at the moment. It is early days in the recovery, and we want to see some sustainability of that recovery, which I think is really what the market is telling us at this point in time. I guess the green shoots need to start to blossom into a more sustainable trajectory. So I think the market will watch over the next 2 to 3 months the data that comes out of there, and if we do start to get some momentum behind the economy, I think that's when equities will really start to perform well, and therefore we are optimistic about 2013 for Chinese equities.
So all that we've discussed, how is this translated into how flows are approaching for the end of the year? Because India, for example, has seen only about half of the funds that it saw in October, November. I mean, will concerns on the fiscal cliff, the Eurozone, China going to dominate, or do you still expect a December rally after what you've seen till now?
Well, if you look at Asia as a whole, flows in the last week or two have actually been the strongest they've been, inflows that is, within the last couple of years. So we are seeing investor demand coming back to the region. It seems to be somewhat regardless of the rising uncertainty as we approach year end. So Again, I think part of this is to do with the fact that people are very defensively positioned, not just in Asia but globally, with regards to their investments. And as this uncertainty starts to lift around the world, people will want equities back in their portfolio. So again, we are optimistic about 2013 equity returns.
Andrew, finally, where do you see the Indian currency, rupee, trading in the near term, and do you see some strength coming back into the currency?
The rupee will be somewhat subject to what the government does, and the reason for that is obviously investors are watching very closely whether the government can get on the reform path. If they aren't successful due to policy or politics, then India's growth will continue to slow, and they won't be able to address things like the inflation problem. I think, therefore, investors will look to sell the rupee, which will drive further weakness in the rupee. However, the government is working very hard at the moment, both in front of the cameras and behind the scenes, to try and resolve some of this political deadlock and reform process. And therefore, it's really subject to how effective they are in that process in terms of the near to medium-term outlook for the rupee.